Today is May 24, 2024. If you're a homeowner, you probably feel the weight of that date right now. Mortgage rates have been on a wild ride, and right now they're sitting at levels that make many of us uncomfortable. You might have bought your home or refinanced maybe somewhere in the 2% or 3% range. Now, with rates hovering significantly higher, the thought of giving up that fantastic deal seems completely illogical. You look at your monthly statement, see that low interest rate, and think, I'm locked in, I'm safe. This feeling is understandable, but it might be costing you more than you realize in the long run. The big question on everyone's mind is simple: when will rates come down? More importantly, what should you do when they do? Waiting without a plan is not a strategy, it's a gamble. Economists and market analysts are pointing toward 2026 as a potential window of opportunity, a period where rates may settle into a more favorable position, creating a prime moment for homeowners to reassess their mortgage. This isn't about impulsive decisions, it's about preparing a smart, calculated financial move that could save you thousands. This guide is designed to be your playbook for that exact moment. It's not about convincing you to refinance. It's about giving you the tools and knowledge to decide for yourself. We will walk through the numbers, the real-world scenarios, and the critical questions you need to ask. Think of this as your personal financial training camp. We're going to get you ready for game day, so when the opportunity arises, you can act with confidence instead of confusion. The goal is to put you back in control of your single biggest expense, your home loan. The strategy we're going to explore is what I call the rate reality check. It's a clear-eyed look at your current mortgage, the potential future of interest rates, and the specific steps you can take to prepare. Many homeowners are simply hoping for the best, but hope doesn't lower your monthly payments or build equity faster. A well-executed plan does. Throughout this series, we will use straightforward language, real numbers, and practical examples to demystify the refinancing process. You'll learn how to calculate your potential savings and how to spot when refinancing is the wrong move for you. This playbook will provide you with clear, number-based guidance. We won't rely on vague advice or industry jargon. Instead, we'll give you simple formulas to calculate your break-even point, the moment when the savings from your new loan have officially paid for the closing costs. Understanding this calculation is crucial. It helps you determine if a refinance makes financial sense based on how long you plan to stay in your home. We'll provide worked examples so you can plug in your own numbers and see the results for yourself, empowering you to make a data-driven decision. The information you're about to receive is based on facts and common financial principles. Our goal is to present a balanced view, showing you both the powerful advantages and the potential pitfalls of refinancing. You will hear a calm, confident perspective that cuts through the noise and sales pitches. By the end of this guide, you will have a comprehensive understanding of the 2026 refi landscape. You'll be equipped with a checklist and a clear set of next steps, ready to decide whether refinancing is the right play for your financial future. Let's get started on building your plan. So, what exactly is refinancing? Let's break it down to its simplest form. Refinancing is the process of replacing your existing mortgage with a new one. The new loan pays off the old loan's balance, and you begin making payments on the new loan. People do this for several reasons, but the most common one is to secure a lower interest rate. A lower rate can lead to a smaller monthly payment, which frees up cash for other goals. It can also mean paying significantly less interest over the life of the loan, allowing you to build wealth faster. But it's not just about the interest rate. Refinancing can also allow you to change the terms of your loan. For instance, you could switch from a 30-year mortgage to a 15-year mortgage. Your monthly payment might go up, but you would pay off your home in half the time and save an incredible amount in interest. On the other hand, you could take cash out of your home's equity to pay for a major expense like a home renovation or to consolidate high-interest debt from credit cards. Each of these options comes with its own set of benefits and risks that we will explore in detail. This playbook will provide you with clear, number-based guidance. We won't rely on vague advice or industry jargon. Instead, we'll give you simple formulas to calculate your break-even point, the moment when the savings from your new loan have officially paid for the closing costs. Understanding this calculation is crucial. It helps you determine if a refinance makes financial sense based on how long you plan to stay in your home. We'll provide worked examples so you can plug in your own numbers and see the results for yourself. The information you're about to receive is based on facts and common financial principles. Our goal is to present a balanced view, showing you both the powerful advantages and the potential pitfalls of refinancing. You will hear a calm, confident perspective that cuts through the noise and sales pitches. By the end of this guide, you will have a comprehensive understanding of the 2026 refi landscape. You'll be equipped with a checklist and a clear set of next steps, ready to decide whether refinancing is the right play for your financial future. Let's get started on building your plan. Let's start with the absolute basics. What does it mean to refinance your mortgage? Imagine your current mortgage is a contract you signed with a lender. That contract has specific terms: the amount you borrowed, the interest rate you pay, and the number of years you have to pay it back. Refinancing is simply the act of getting a brand new loan to completely pay off that old one. You are essentially swapping your old mortgage contract for a new one. The new loan will have its own set of terms, hopefully ones that are much better for your financial situation. Your old loan disappears and you start fresh with the new one. The primary goal for most people who refinance is to save money. This usually happens by securing a lower interest rate. Even a small reduction in your rate can have a huge impact on your monthly payment and the total interest you pay over the long haul. For example, getting a new loan at 4.5% to replace an old one at 6% can translate into hundreds of dollars back in your pocket each month. That extra cash flow can be used for anything from building your emergency fund, investing for retirement, finally tackling that kitchen remodel you have been dreaming about for years. However, a lower rate isn't the only reason to consider this move. Refinancing gives you the power to change the fundamental structure of your loan. You might be in a 30-year mortgage and decide you want to pay it off faster. By refinancing into a 15-year loan, you can become debt-free much sooner. Yes, your monthly payment will likely increase, but the amount of interest you save over the life of the loan can be staggering. It is a powerful strategy for building equity and achieving financial freedom ahead of schedule. We are talking about tens of thousands of dollars in savings, even hundreds of thousands of dollars in savings. Ultimately, refinancing is a financial tool. It is not a magic wand, but when used correctly, it can be incredibly effective. The key is to understand that you are taking on a new debt to eliminate an old one. This process requires you to qualify for the new loan just as you did for your original mortgage. Lenders will look at your credit score, your income, your existing debts, the value of your home. It's a formal process with paperwork, underwriting, closing. The decision to refinance should always be based on careful calculation and a clear understanding of your personal financial goals, not just a desire to chase a lower number. When you start exploring refinancing, you will quickly hear about two main types: the rate and term refinance and the cash out refinance. Let's break down what each one means. The most common type is the rate and term refinance. It changes the interest rate. It changes the term of your loan. The new loan just pays off your existing mortgage balance. You can roll closing costs into the loan. You are not taking any extra money out of your home. The goal is to improve your loan's conditions. Think of it as a straightforward swap. Example: $300,000 balance on a 30-year mortgage at 6.5%. You find a new 30-year loan at 5%. The new loan pays off that $300,000 balance. You might want to lower your monthly payment or switch to a 15-year term to pay the house off faster. This is the simplest option, best for homeowners aiming to save on interest. The second major type is the cash-out refinance. It's more complex, but it can be powerful. You take a new mortgage larger than what you currently owe. The new loan pays off your existing mortgage, and you receive the difference in cash at closing. For example, home worth $500,000, you owe $250,000. You refinance for $300,000. That pays off the $250,000 loan and gives you $50,000 in cash. People use cash-out refinances for many reasons. Fund a major home improvement project, debt consolidation, use the cash to pay off high-interest credit cards or personal loans. Mortgage rates are often much lower than credit card rates, which can save money and simplify payments. But remember, you're converting unsecured debt into secured debt. Your home is on the line if you fail to pay. Section 3. The people behind the process. Who offers refinances? So, you have decided you want to explore refinancing? Where do you go? The good news is, you have many options. The same institutions that make original home loans also handle refinances. Start with your current lender. Other major banks, credit unions, mortgage brokers. Your current lender is often a good first stop. They already have your information on file. That can sometimes streamline the application process. They might even offer you a competitive deal, sometimes with reduced fees. It's always worth a phone call to see what they can do for you. Next, shop around with other lenders, large national banks, smaller community banks, local credit unions. Big banks may offer a wide array of digital tools and a national presence. Credit unions are member-owned nonprofits. They often boast excellent customer service and can sometimes offer lower rates and fees. Do not underestimate your local community bank. They provide a more personal touch and may work with you based on your local reputation. Another powerful option is working with a mortgage broker. A broker is an independent pro who works with many lenders. Instead of applying at 10 different banks, you submit one application to the broker. The broker then shops your application around their network. They find the best possible rate and terms for your situation. This can save you a tremendous amount of time and effort. Good brokers have deep industry knowledge. They can often find deals you might not find on your own. Brokers get paid a commission. It's usually included in the loan's closing costs. The key to this entire process is comparison shopping. Never take the first offer you receive. Get quotes from at least 3 to 5 different sources. Include your current lender, a national bank, a local credit union, perhaps a mortgage broker. When you compare offers, use the loan estimate form. Check the interest rate. Check the annual percentage rate, the APR. Check the estimated closing costs. Competition among lenders is what gets you the best deal. Make them work for your business. Section 4. The timeline and the costs, what to expect. Refinancing your mortgage is not an overnight process. It takes time, typically 30 to 60 days from application to signing. The first step is the application, where you provide detailed financial information. Income, assets, debts. The lender will pull your credit report. They will begin the underwriting process. Underwriting verifies your information against loan guidelines. This is the most time-consuming part. They will request documents, pay stubs, tax returns, bank statements. During this period, the lender will order a home appraisal. An appraiser will visit your property. They'll determine its current market value. That value confirms the home secures the new loan amount. Appraisal value affects how much you can borrow, especially cash-out refis. Once appraisal and documents are approved by underwriting, the lender will give you a clear to close. That means your loan is fully approved. You can schedule your closing to sign final documents. This process isn't free. Refinancing carries closing costs, like your original mortgage. Fees typically range from 2% to 5% of the new loan amount. On a $300,000 refi, expect roughly $6,000 to $15,000 in closing costs. These fees cover several services: appraisal fee, lender origination fee, title insurance, attorney fees, recording fees, local government. Get a detailed breakdown on the loan estimate form. You generally have two options to handle costs: pay them out of pocket at closing, or roll them into your new loan balance. Paying out of pocket lowers your loan amount, but requires cash on hand. Rolling costs into the loan requires no upfront money, but you pay interest on those costs for the life of the loan. This is a key decision. We'll show how to calculate the break-even point later. Section 5, the loan itself. Fixed versus adjustable, and 15 versus 30. When you refinance, you also choose the loan type: a fixed-rate mortgage, the popular straightforward option. With a fixed rate, your interest rate is locked in for the life of the loan. Whether a 15-year or 30-year term, principal and interest won't change. That gives predictability and stability, easy budgeting. An adjustable rate mortgage, or ARM, is different. An ARM typically starts with a lower teaser interest rate for an initial fixed period of 5 years, 7 years, 10 years. After that period ends, the interest rate can change, usually once a year. The new rate is based on a financial index plus a margin set by the lender. ARMs can be attractive because the initial rate is often much lower than a fixed rate. That yields a lower initial monthly payment, but the risk is uncertainty. Your rate and payment could rise, sometimes substantially. ARMs have caps that limit increases at each adjustment and over the loan's life. Still, a rising rate environment can cause payment shock. An ARM can make sense if you know you'll sell before the fixed period ends. For example, a 7-year ARM and you plan to move in 5 years. Finally, choose your loan term: 30-year or 15-year. 30-year spreads payments out, giving a lower monthly payment, but you'll pay significantly more in total interest over the life of the loan. A 15-year loan has a higher monthly payment, but it usually comes with a lower interest rate, and you pay off the loan in half the time. That saves a huge amount in interest and builds equity much faster. The choice depends on your cash flow and long-term financial goals. As you navigate this process, you must keep your guard up. The world of mortgages can attract scammers' high-pressure sales tactics. Be wary of any offer that sounds too good to be true, because it probably is. Watch out for unsolicited offers you receive by mail, email, phone. Promises of impossibly low rates or guaranteed approval are red flags. Legitimate lenders do not operate that way. Never pay a large upfront fee just to apply. Appraisals and similar fees are paid at time of service or as part of closing costs, not before you apply. This playbook wasn't meant to push you to refinance. It was to give you knowledge and confidence to decide for yourself. 2026 may present an opportunity, but it won't be right for everyone. For some, it will be a financial masterstroke, saving tens of thousands. For others, the right move is to stand pat with a great loan. No single right answer, only the right answer for your situation. The choice is in your hands. So, take a deep breath. You have the tools. You have the framework. You understand the numbers. You understand the risks. You understand the rewards. Watch the market. Keep your financial house in order. Prepare to act when the time is right. Replace hope with a plan. You've taken the most important step. You are no longer a passive passenger. You are the pilot, calm and in control. Make your calculations. Trust your judgment. Build the financial future you deserve.